Spirit Airlines, the once booming budget airline that promised to democratize the skies, well, like its name implies, it's now dead. Yes, my friends, this is the carrier that built an empire on ultra low fares and a la carte basically everything. This was something that was a household name, a source of memes, the Waffle House of the skies, if you will, or if you've ever seen any of those videos of gate agents and customers legitimately actually fighting, because that is a thing. But now it is fighting for its life. Or I guess at this point, we should say that it's over because it is now filed for bankruptcy and ceased operations as of May 2nd, 2026, which is something that leaves passengers stranded and the aviation industry is reeling. But when I'm talking about this isn't just another corporate failure. This is a brutal verdict on an entire business model that transformed how we fly, and yet it doesn't really seem to apply anymore. Now, my friends, when I'm going and talking about this, I don't want it to sound like a spoiler or anything like that because we still do not necessarily know what is going to happen. But just as the dust was settling on Spirit's collapse and private equity vultures have started circling, an unlikely hero seemingly has emerged, weirdly enough, here on the internet. I'm not sure if any of you have seen that, but Hunter Peterson, a 22-year-old TikTok creator and voice actor who posted a viral video that would propose what sounded like, I mean, honestly, a bit of a crazy idea. We could buy Spirit Airlines, and that actually seems to be doing something. What happened next was nothing short of astonishing. Peterson's crowdfunding campaign to nationalize Spirit Airlines, owned by the people, is something that at this point has attracted over 370,000 supporters, pledging hundreds of millions of dollars, with some reports putting the total pledges at more than 300 million at the time that I'm making this, which I had started working on this in early to mid May of 2026. And I think now at the time that I'm recording this, it is May 12th. In fact, so much support was thrown behind him that the website that he created, letsbuysPiritAir.com, crashed after receiving massive responses from over 124,000 patrons, pledging more than $88 million in just the first few days. Now, whether or not he will actually be successful, we technically speaking do not know, but this is something that, even if it does not work, is something that could change the history not just of the aviation industry, but basic economics as we know it, as nothing of this scale has literally ever been done before. But again, we are not there yet. So once again, I don't want to spoil things or give the wrong impression that things have been magically fixed because no, they absolutely have not. But my friends, before we go any further, I would like to thank today's sponsor, MyHeritage. And I will say this right now, if you've not heard of MyHeritage, you have got to try this. I have used it personally for years in order to build my own family tree. I love it. It has billions of historical records that I've been able to construct a family tree going back hundreds of years on. But now they have something even cooler that they've reached out to me to do. MyHeritage has a newly expanded DNA service where you can actually estimate your ethnicity as well as get the ancient origins of your DNA. In my case, what is so incredibly cool, and I was not expecting in the first place, is I'm actually, apparently, a lot more Irish than I anticipated, despite my very Germanic features. Along with that, it's very heavily Scottish, Welsh, and English, which again, did not expect it because again, very Germanic in appearance. And then there you go, there's the 11% Danish that I anticipated, considering what I found here for my DNA matches. Go figure, I'm like 10 different types of mayo, yeah. But what is more fascinating about all of this is that from the concentration of Irish, English, Scottish, Welsh, etc., I had fully been anticipating more Germanic origins. And if you go to their new Ancient Origins feature, where you can get your breakdown of your ancient origin DNA, you'll actually find that in my case, from the Bronze Age to Iron Age, the Roman era, and the Middle Ages, you actually start to see, oh, the majority of my DNA does in fact come from Germanic origins, and that is actually what would then migrate over the course of the Middle Ages to go over to the British Isles. So it starts to actually make more sense, which is cool. But also, there's now DNA matches that I've been able to find long-lost relatives. Obviously, I can't show who exactly is on here, but I have found that I still have a large number of relatives, fourth and third cousins, that exist in Denmark, in Norway, in plenty of other places. So this is actually something that if you wanted to see that you were related to me, you could go and do that, and who knows, maybe you'll pop up on my list. Genuinely, among all the different kinds of services that I have used, this has got to be one of the coolest things that I've ever done in order to be able to bond with my family. And so if you want to go and try this yourself, you need to either click the link down in my description or scan the QR code that you can see up here that's been up the whole time. And along with that, make sure to use my coupon code HISTORY19, because if you do that,
That is going to give you free shipping for your DNA kit, meaning that the entire thing is just going to be like 19 bucks. That is not bad at all. Oh, also, I nearly forgot to mention that MyHeritage is committed to not selling or licensing out any of your genetic data. It is something that is incredibly safe. Along with that, for that exact price, you are also going to be getting a 30-day free trial with MyHeritage, and genuinely, there's no reason to really pass this up. This is probably one of the coolest things, again, that I have done recently. So, thank you, MyHeritage, for sponsoring this video, and my friends, absolutely go and check it out. It is genuinely very cool.
So, today, my friends, what it is that we're going to be doing is we're going to be explaining why exactly Spirit failed. We're going to be diving into both the perfect storm of rising costs, the operational chaos and strategic blunders that they made with an incredibly stupid merger plan that brought down this aviation disruptor, as well as the viral movement now that is trying to resurrect it, as well as some other really incredibly stupid internet drama that is surrounding this whole thing. So, please, by all means, stick around. I understand that this is a long video, but there's actually a lot that we need to explore in here. More importantly, we're going to be exploring what Spirit's collapse actually signals about the future of budget travel, whether ultra low cost carriers can even survive in today's economy, and what this means for your wallet the next time that you search for a cheap flight. Because the skies are likely going to be getting significantly more expensive, and Spirit's downfall and the extraordinary public reaction to it, that is just the beginning, my friends. And speaking of the beginning, you all know by now here how it is that we do things on the history of everything. In order to explain what is actually going on now, we need to first go back to, well, the start, which means that we're going to need to briefly explain the actual story of Spirit itself, because I don't think this is something that necessarily a lot of people understand. So, pack your bags, my friends, and prepare for oversized and overweight baggage fees, because you know that I'm about to say way too much. Going back to the beginning here, my friends, Spirit Airlines has one of the most unusual corporate genealogies, if you want to use that term, in American aviation history, with roots that really don't have anything to do with passenger flight. And that's actually what makes it weird in the first place, that this whole thing was a disruptor. Because the story begins in 1964 in Macomb County, Michigan, when an entrepreneur by the name of Ned Homfeld would go and found Clippert Trucking Company, which was a regional freight hauler that would serve the industrial corridors of the upper Midwest. Detroit in the 1960s was the beating heart of American manufacturing, and trucking companies that could move efficiently would move goods between automotive plants, suppliers, and distribution centers. And this was something that was a pretty profitable enterprise. Homfeld would run Clippert successfully for years, and that is what it is that he did. And you may be wondering, why am I talking about a trucking company right now? Well, by the late 1970s, this guy saw greater opportunity in the leisure travel industry, especially as deregulation began transforming American transportation. In 1980, Homfeld would go and restructure the company as Charter One, a Detroit based travel and tour operator that would organize package trips to popular gambling and entertainment destinations like Atlantic City, Las Vegas, as well as the Bahamas. Now, Charter One would initially go and charter, as the name implies, aircraft from other operators to fly its own customers. But as the business grew, Homfeld would make the strategic decision to bring flight operations in house. By 1990, Charter One had acquired its first aircraft and obtained the necessary certifications to operate scheduled passenger service. And in 1992, the company would officially rebrand as Spirit Airlines. This being something to reflect its new identity as a full fledged commercial carrier, and that was the start of the airline as it would exist. As time went on throughout the 1990s, Spirit would operate as a relatively unremarkable, low cost regional carrier. They would fly older Douglas DC 9s and McDonnell Douglas MD 80s on routes that would connect Detroit to Florida vacation destinations like Fort Lauderdale, Orlando, Tampa Bay, etc. The airline would compete primarily on price against the major carriers and other low cost operators of the era, and as time went on, Spirit would gradually expand its network over the course of the late 1990s and early 2000s, even adding service to the Caribbean and Latin America, and establishing a secondary hub in Fort Lauderdale that would eventually become its operational center of gravity. The airline would also experiment with various different fleet types, including Airbus A319s, A321s, before standardizing on the Airbus A320 family. Now, during this period, Spirit was fairly profitable. It was doing pretty nice, but it was Overall, a very unremarkable airline. Like it existed, but it wasn't anything important. It was one of the many small, low cost carriers that were competing for leisure travelers in a very fragmented post deregulation market where a lot of these little ones were kind of popping up. Now, the airline would weather the post 9/11 industry downturn that would bankrupt many of their competitors. But by the mid 2000s, it was very clear that Spirit still needed a more distinct strategy and identity to thrive against the increasingly competitive legacy carriers that were trying to dominate the market and the rapidly expanding Southwest Airlines. This, my friends, is where Spirit became Spirit as we kind of know it today. The pivotal transformation would come in 2006 when Indigo Partners, which is a private equity firm specializing in airline investments, would acquire a controlling stake in Spirit Airlines. Now, Indigo was led by a guy by the name of Bill Frank, a veteran aviation executive who had previously run American West Airlines and developed a fascination with the European ultra low cost carrier model that was pioneered by things like Ryanair and Wizz Air. For any of you who are perhaps not familiar with these, this is where a lot of memes come out of Europe of certain instances. Like, I remember a famous case of a guy from Scotland finding that it was much cheaper for him to use Ryanair to fly from Scotland down to Spain and then from Spain to London to visit one of his friends than it was to just take a train down there. That is how stupidly cheap we're talking about here. With I've seen prices as low as like 20 to $30 for a flight, like an actual multi-hour long flight. It's absolutely insane. And I've flown on a couple of them and they're not comfortable. Believe me. But now Frank believed that American consumers, like their European counterparts, would tolerate significant inconveniences and not being comfortable in exchange for genuinely rock bottom fares, and that the existing American low budget carriers like Southwest or JetBlue or others, they had simply become too comfortable, offering too many included amenities that people were getting charged for as part of an overall bill, and that is something that would leave money on the table. So Frank would go and install Ben Baldanza as CEO in 2006, and together they engineered one of the most radical business model transformations in American aviation history. This new Spirit was not going to merely be cheap. No, 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 no. They were going to be aggressively, almost defiantly stripped down, charging customers for every conceivable service you could possibly have, while simultaneously advertising eye poppingly low base fares. Like you may see a ticket price that is $40. And if you are going there with basically no baggage or anything like that, awesome, great. But if you have baggage and if that baggage is overweight and if you want to do anything to choose your own seat or anything else, those fees start racking up very quickly and the $40 could very quickly turn into $180, something like that. The implementation of the ultra low cost carrier model at Spirit was very systemic and ruthless. Beginning in 2007, the airline would introduce a cascade of new fees that kind of shocked the industry and infuriated consumers. What I mean by that is that Spirit became the first US airline to actually charge for checked baggage in 2007. For a lot of people who travel nowadays, they may not even be aware that that was not always a thing. Spirit is what started that, and then they doubled down by becoming the first airline anywhere to charge for carry on bags in 2010, with fees that were actually higher than the checked bag fees to discourage passengers from clogging overhead bins. Now, the airline would go and charge for advanced seat selection, with prices varying dependent on where that seat was actually located, and passengers would pay for more things like printing boarding passes at airport kiosks rather than at home. Water, soda, coffee, snacks, all of this would cost money during flights. The airline would reconfigure their aircraft to maximize as many seats as possible on one plane, installing 178 seats on Airbus A320s, where most airlines would probably go more around 150. A full 28 seats more, with seat pitches as low as 28 inches, which was significantly tighter than industry standards. The seats themselves were very thin, lightweight, pre reclined models that didn't actually recline. They were just stuck and padded minimally to save weight and reduce fuel consumption. Spirit would eliminate frequent flyer benefits that competitors offered for free, charging customers to go and join their rewards program. Even calling customer service or booking through a human agent is something that could incur fees, with the airline going and aggressively pushing all transactions to their website in order to reduce labor costs. Literally, if there was a way to pinch money, they did it. And along with that, the marketing strategy that accompanied this operational transformation was also very provocative. Spirit's advertising would lean into their more edgy, double entendre laden campaigns that would frequently court controversy, we will say. Email subject lines that ad campaigns would reference everything from political scandals to celebrity gossip, natural disasters, literally anything and everything that Spirit could think of, they would just throw out there on the media. Anything that was designed to grab attention through shock value rather than the more traditional airline imagery of a smiling flight attendant and exotic destinations. No, 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 no. This was going to be the Waffle House of the skies. The airline would embrace its reputation for being uncomfortable, essentially telling customers, yeah, look, we know we're not actually glamorous or nice or anything like that, but look at these prices. And honestly, it worked. This anti-marketing approach proved remarkably effective at building brand awareness among people that were always looking to save more money. Travelers who didn't care about luxury and they just wanted to get to somewhere as cheaply as possible. Spirit's leadership would argue that complaints about the airline came from customers who didn't really understand the business model, like a vegan going into a butcher shop. The entire purpose of Spirit was to do exactly this. They weren't promising a premium experience, it was promising the lowest possible fare, and customers who wanted more amenities should pay for them a la carte, or they could F right off and go fly on a different airline. That wasn't Spirit. They didn't care. Simple, I know, and very blunt, but simultaneously very effective. Fast forward a little bit of time, and in 2011, Spirit Airlines would complete an initial public offering on NASDAQ Stock Exchange, raising approximately $187 million dollars and giving the airline access to public capital markets in order to fund their more aggressive expansion that they were now launching. The IPO was successful despite skepticism from many industry analysts who kind of doubted whether or not the ultra low cost model could actually scale in the United States, where consumers were generally believed to expect more amenities than the European budget travelers. From here through the 2010s, Spirit's growth, though, was explosive, kind of proving the naysayers wrong, at least for a while. The airline would place massive orders for new Airbus A320 family aircraft, including the more fuel efficient A320neo variants, growing its fleet from around 30 aircraft in 2010 to over 150 by the end of the decade. After this, Spirit would aggressively expand into new markets, establishing major operations in Las Vegas, Atlantic City, Dallas Fort Worth, Detroit, Chicago, O'Hare, Houston, all while continuing to dominate Florida and Caribbean leisure routes. The airline's network strategy would focus on what executives called stimulating demand. Basically, they would enter markets with fares so low that they actually generated entirely new travel that wouldn't have happened at competitors' prices rather than simply stealing customers from existing operators. Like they could go into a market and say like, "Hey, there's a bunch of people in this area but they want to go to Las Vegas or somewhere else, but no other carriers in this will fly people to Las Vegas because, well, it's kind of expensive and they don't really know the demand." And then Spirit would go, "Hey, we're going to do a flight. We're going to make it stupidly cheap to do so." And then people who live in that area would be like, "Oh, wow. Hey, we could go to Las Vegas for $50 and that's it. Let's do it." And it would actually create new demand. Really, the financial results from this period were extraordinary. Spirit would consistently post operating margins of 15 to 20%, which is among the highest in the entire global airline industry. It was very profitable. The airline's revenue from ancillary fees would grow to represent nearly half of all their total revenue. Not like, their base prices of what they would get from, say, the ticket or someone actually paying to check baggage. We're talking about fees where people would get punished, with each passenger generating an average of $50 to $55 in non ticket fees. An industry leading figure that legacy carriers really could only dream of actually matching. Wall Street would reward Spirit's performance with soaring stock price, and the company would become a darling of growth investors who saw it as the future of American aviation. Bob Fornaro, who replaced Baldanza as CEO in 2016, would continue the aggressive growth strategy while attempting to modestly improve customer service to reduce the airline's, shall we say, notoriously high complaint rates, which is something that never really went away. Ted Christie would take over as CEO in 2019, inheriting an airline that appeared at this time to be at the peak of its powers, with hundreds of additional aircraft on order and ambitious plans to grow into one of the largest carriers in the Americas, challenging even the great legacy carriers. This is 20 freaking 19, only 7 years ago at the time that I'm making this video in the first place. So, how on God's green earth did Spirit manage to fail when this short of a time ago they were effectively flying sky high? Well, we've spoken about things in rather glowing terms, but yeah, reality tends to hit pretty hard when you least expect it. And remember what I said that we are at 2019 here? Remember what also started in 2019? Yes, my friends, the first existential threat to Spirit's business model would come with the COVID-19 pandemic, which really kicked in spring of 2020, which this is something that absolutely devastated global air travel, and it would hit leisure-focused, ultra low-cost carriers especially hard. You may wonder, why is that the case? I mean, why is Spirit getting hit particularly hard in comparison to other things like Delta or American Airlines or something like that? Well, unlike legacy carriers that had more substantial cargo operations and corporate contracts, Spirit was almost entirely dependent on price sensitive leisure travelers who simply stopped flying when the pandemic struck. The airline would burn through cash as a result at alarming rates because they simply had no customers, especially over the course of spring and summer of 2020. They only really managed to survive through this time because of the federal CARES Act assistance and additional debt financing. Spirit would, over the course of this time period, take on billions of dollars in new debt, dramatically weakening their balance sheet and increasing their interest expenses, just as the airline industry was about to face something that was an extraordinary challenge in recovering after the pandemic. And so, while Spirit's traffic would recover relatively quickly as leisure travel began to rebound over the course of 2021 and 2022, the airline's financial health never really recovered after this. And the debt that they managed to accumulate during the pandemic would then haunt it for the remainder of its existence. And this, my friends, is something that brings us to the merger. The thing that I mentioned at the very beginning of this video, the hammer blow that would cripple Spirit, leaving it limping all the way to its grave. The story begins in the latter half of 2021, this being when the airline industry was tentatively trying to emerge from the depths of the COVID-19 pandemic, and executives were beginning to think strategically about the post pandemic competitive landscape. Indigo Partners, which is the private equity firm controlled by Bill Frank that had originally transformed Spirit into an ultra low cost carrier back in 2006 that I mentioned here before, he had subsequently divested its Spirit holdings, or Indigo had, while retaining controlling interest in Frontier Airlines, another ultra low cost carrier, and Indigo had remade that into one as well. Like, they did this to both Spirit and also Frontier. It's part of the same kind of vein. Frank had long believed that the American ultra low cost segment was way too fragmented to achieve any kind of real optimal scale. There was too many low cost carriers and they wanted something that was larger and national. That he saw an opportunity in the pandemic's aftermath to combine the two largest ULCCs into a single dominant entity, something that on its own, if Frontier and Spirit combined, they would be able to compete effectively with the big four legacy carriers. And so, beginning in late 2021, Frank and Frontier CEO Barry Biffle would initiate quiet discussions with Spirit CEO Ted Christie and Spirit's board chairman Mac Gardner about a potential combination. With the talks intensifying over the course of winter of 2021 and 2022, as the parties would work through valuation, governance, operational integration issues, the things that would actually happen for a merger. And so, on February 7th, 2022, Frontier and Spirit would jointly announce a definitive merger agreement. under which Frontier would acquire Spirit in a cash and stock transaction valued at approximately $2.9 billion. Spirit shareholders would receive 1.9126 shares of Frontier common stock plus $2.13 in cash for each Spirit share that they owned. Now, the deal terms were structured to give Frontier shareholders 51.5% ownership of the combined company and Spirit shareholders 48.5%, with Bill Frank serving as the chairman of the merged entity and Matt Gardner as vice chairman. Ted Christie was slated to become president of the combined airline, while Barry Biffle would serve as CEO. And this is something that would suggest a relatively balanced power sharing arrangement between the two organizations. The merger announcement would also include projections of $500 million in annual synergies once integration was complete, primarily through aircraft purchase leverage, network optimization, technology consolidation, and overhead reduction. They had a lot of things that would still need to be worked through, of course. The combined airline would have approximately a fleet of 350 aircraft, serving over 145 destinations across the Americas, and could generate annual revenue exceeding $5 billion. And that, on its own, with these two entities combined, would make it the fifth largest U.S. airline by revenue. It was, all things considered, a pretty big deal. Really, when we're going and thinking about this, strategically, the deal made a lot of sense. Frontier's strength in the western United States would complement Spirit's dominance in Florida and the Caribbean, while also combining the two organizations would have definitely created sufficient scale to negotiate better aircraft prices, airport fees, and supplier contracts because they would no longer be just two kind of moderate low cost carriers. It would be the next great potential legacy carrier, but of ultra low cost flying. The initial market reaction to the Frontier Spirit announcement was cautiously positive, with both company stock prices rising modestly as investors digested the strategic rationale of the whole thing. However, the problem is that the deal almost immediately attracted some unwelcome attention from JetBlue Airways, the New York based hybrid carrier led by CEO Robin Hayes. And this, my friends, is where everything starts to go wrong really fast. You see, JetBlue had spent years pursuing a strategy of selective premium positioning that differentiated it from both legacy carriers but also the ultra low cost competitors, with industry leading legroom and coach, free in flight Wi Fi and snacks, and the popular Mint premium cabin product on transcontinental and transatlantic routes. Basically, Hayes had long believed that JetBlue needed greater scale to compete effectively with the Big Four, and he had already secured a controversial Northeast Alliance partnership with American Airlines back in 2020 to share routes and frequent flyer benefits in the New York and Boston markets. And so, looking at Spirit, Hayes saw an irresistible opportunity. Here, he could acquire Spirit, and that could give JetBlue immediate scale. It could give them aircraft, it could give them pilots, it could give them access to leisure markets in Florida and the Caribbean, where Spirit already dominated. And this is something that would transform JetBlue from a mid sized niche carrier into a genuine challenger to the Big Four. Really, the strategic logic was so compelling from JetBlue's perspective that Hayes was willing to risk a hostile takeover battle in order to secure it. And again, that is where everything starts to go wrong. On April 5th, 2022, JetBlue would launch its surprise counterbid for Spirit, offering $33 per share in cash, a transaction which was valued at approximately $3.6 billion, which would represent a 52% premium over Spirit's pre announcement trading prices and a substantial premium over the Frontier deal's implied value. This was a really juicy offer. The all cash structure was especially attractive because it eliminated the execution risk that was inherent in Frontier's stock based offer, where Spirit shareholders' ultimate proceeds would depend on Frontier's post merger stock price performance. Because if they merged and everyone in Spirit received price of the stock for Frontier, if Frontier stock dropped, that means the Spirit shareholders also lost. In this case, they didn't have to worry about that. They would just get cash. Lots of extra cash. JetBlue's offer letter sent to Spirit's board would argue that JetBlue combination would create way more value for Spirit shareholders, the employees, and customers than Frontier's deal. while also acknowledging that JetBlue's plan was to convert Spirit's high density aircraft to JetBlue's more comfortable configurations. And that is something that would reduce total seat capacity. They were going to go for a nicer experience, not the ultra low cost budget flights. Hayes positioned this capacity reduction as a feature rather than a bug, arguing that the disappearance of Spirit's bare bones product would actually push customers towards JetBlue's higher quality alternative while still maintaining more competitive pressure against legacy carriers. The JetBlue bid would create an immediate crisis for Spirit's board, which did, by the logic of the way that a board works in any company, they had a duty to consider any superior offer, but they had already committed to the Frontier deal, which had a substantial breakup provision if they backed out of it. Like, if they backed out now, they would get some serious penalties, and that created a large number of problems. See, Spirit's board would initially respond to the JetBlue offer by acknowledging that they did receive it, and they did indicate that they would evaluate the proposal in accordance with their own duties and what they were required to do so. But here's the funny thing: on May 2nd, 2022, the board actually rejected the JetBlue bid, citing concerns about antitrust risk and the likelihood that regulators would end up blocking a JetBlue Spirit combination. Because JetBlue's existing Northeast alliance with American Airlines, remember the thing I said that was controversial before, that itself was already under DOJ investigation. The board's rejection was a thinly veiled defense of the existing Frontier deal, and JetBlue would immediately escalate the battle by launching a hostile tender offer directly to Spirit shareholders on May 16th, 2022, at $30 per share. Yes, this was slightly lower than their initial bid as a negotiating tactic, but it was still substantially higher than Frontier's offer. JetBlue would simultaneously launch a public campaign attacking Spirit's board and management for putting their personal interest in the Frontier deal ahead of shareholder value, arguing that the lower Frontier valuation is something that reflected the personal preferences of Spirit executives who didn't want to give shareholders the better value. They instead wanted to just have larger roles in the new combined company rather than get bought out in a JetBlue acquisition. The rhetoric between the parties would grow increasingly hostile over the course of May and June of 2022, with public letters, press releases, shareholder presentations, all of these things flying in both directions as each side tried to win the support of the Spirit's investor base. Now, how did Frontier respond to all this, you may wonder? They kind of panicked. Frontier responded to the JetBlue threat by repeatedly improving their own offer terms, increasing the amount of cash that was being given, adding a special dividend, and ultimately even offering a $250 million reverse termination fee that would be paid to Spirit if regulators blocked the Frontier deal. So if they tried to merge and then, oh, it turns out that the government would not allow the merger to go through, Frontier would be required to pay $250 million to Spirit. JetBlue would counter with their own enhancements, eventually offering a $350 million reverse termination fee plus prepayment of $1.50 per share to Spirit shareholders, and ultimately raising their own bid to $33.50 per share for a total transaction value of approximately $3.8 billion. The bidding war, as a result, would reach its climax in late July of 2022 when Spirit would twice postpone scheduled shareholder votes on the Frontier deal, recognizing that the votes would likely fail given the substantial premium that JetBlue was offering. And that is kind of how it went. On July 27th, 2022, Spirit's board would finally capitulate, terminating the Frontier merger agreement and paying Frontier the $94.4 million breakup fee that they had to pay, and entering into a definitive merger agreement with JetBlue at $33.50 per share in cash. Spirit shareholders would approve the JetBlue deal on October 19th, 2022, with overwhelming support, and the transaction was scheduled to close in the first half of 2024, of course, pending regulatory approval. So, yeah, that is some serious corporate drama that we have not really covered here before on this channel. But, it's still good information to know. But wait, hold on. If everything was good now, then why the hell did all of it crash and burn? Well, remember what I just said about the uncertainty that they had towards regulatory approval? Yeah, that's where things get a lot harder and everything goes to absolute crap. See, the regulatory review process for the JetBlue Spirit merger was already contentious from the very beginning, and that ended up proving fatal to the transaction. The Biden administration had taken over office in January of 2021 with a stated commitment to aggressively enforce antitrust efforts, especially in concentrated industries like airlines. And the appointment of Jonathan Cantor as Assistant Attorney General for Antitrust and Lena Khan as FTC Chair would signal a fundamentally different approach than the more relaxed Trump era enforcement that had generally permitted airline consolidation. The Justice Department's antitrust division began reviewing the JetBlue Spirit deal immediately after announcement, requesting voluminous documents and conducting extensive interviews with industry participants, consumer advocates, and economic experts to figure out what was going on and what this would do. Adding to the regulatory complexity, the DOJ was also simultaneously preparing its own lawsuit that challenged JetBlue's existing Northeast alliance with American Airlines that had begun operating back in 2020, and which the DOJ viewed as a backdoor merger that reduced competition in New York and Boston markets without ever actually going through a formal merger review. The Spirit transaction would effectively give the DOJ a second bite at constraining JetBlue's competitive impact, and antitrust enforcement would go and approach the deal with deep skepticism, we would just say, from the very get go. See, the Justice Department would file their own lawsuit to block the JetBlue Spirit merger in March 7th of 2023, this being in the District of Massachusetts, with attorney generals from 6 different states and the District of Columbia going and joining the federal case. The complaint argued that the merger would eliminate the largest ultra low cost carrier in the US, and that is something that would remove a unique competitive force that disciplined fares across the industry by stimulating price sensitive demand and constraining the price power of larger carriers. Basically, just by Spirit existing as a low cost carrier, an ultra low cost carrier, this is something that made the legacy carriers have to lower their prices a bit in order to be able to try and compete. If you remove them, this would remove that competition and thus cause prices to go up. The DOJ's economists presented analyses showing that Spirit's entry into a market would typically cause fares to fall by anywhere between 10 to 30% in that area, and that the airline's complete elimination would inevitably thus lead to higher prices for the more cost conscious consumers that relied on their services. The complaint would also specifically highlight JetBlue's stated intention to reconfigure Spirit's high density aircraft to JetBlue's more spacious configurations, arguing that this 15 to 20% reduction in seat capacity was effectively an admission that the merger was going to reduce competition in the budget travel segment. Like straight up, JetBlue's own plan was the proof that the government needed. The lawsuit also incorporated evidence from the parallel Northeast Alliance case, in which the DOJ won that in May of 2023, when a different federal judge would order American and JetBlue to dissolve their partnership. And that, I know we're getting really into the nitty gritty corporate aspect here, but that would be the real beginning of the end. The JetBlue Spirit antitrust trial would begin on October 31st, 2023, before Judge William G. Young in the U.S. District Court for the District of Massachusetts, an octogenarian Reagan appointee who is known for his skepticism of corporate consolidation and also being a bit of a colorful figure in the courtroom. The trial would last approximately 3 weeks and would feature extensive testimony from airline executives, economists, industry experts, you name it, they were there. Now, JetBlue's defense would center on the argument that the combined airline would create a more effective competitor to the big four legacy carriers and would generate consumer benefits that outweighed the local concerns about reduced ultra low cost capacity and increased prices. JetBlue's executives would testify that Spirit was a struggling carrier that would eventually fail anyway, absent of a merger, and would make the comparison not between competition with and without the deal, but rather between a JetBlue owned Spirit or no Spirit at all. Like if JetBlue didn't do this, if the merger did not go through, it means that Spirit's days were numbered and they were going to lose it anyway. The DOJ would counter that Spirit's financial difficulties were temporary and self inflicted, and that the airline would retain substantial competitive value with time, and that even a weakened Spirit still provided more competitive discipline than its complete elimination would. Judge Young, as a result, would issue his decision on January 16th, 2024, ruling decisively in favor of the Justice Department and blocking the JetBlue Spirit merger. The 109-page opinion was a scathing thing in its assessment of the proposed transaction, finding that the merger would substantially lessen competition in numerous local markets and that the national ultra low cost segment would be effectively destroyed, harming millions of cost conscious travelers who depended on Spirit's bargain fares. Judge Young would specifically reject JetBlue's failing firm defense, finding that Spirit had not adequately explored alternatives to acquisition and that the airline's problems, while yes, they absolutely were real, all the stuff that they went through during COVID was real, but that didn't justify eliminating competition. The opinion would contain rather colorful language criticizing JetBlue's strategy as one that would, and I quote, kill the value low cost airline that, even now, JetBlue cannot offer, end quote, and concluded that consumer harm from reduced competition would substantially outweigh any efficiency or comfort benefits that the parties claimed. JetBlue and Spirit would initially announce that they would appeal this ruling, but after evaluating the situation and considering the substantial costs of any continued litigation, it just simply wasn't worth it. The parties would announce on March 4th, 2024, that they were terminating the merger agreement entirely, with JetBlue having to pay Spirit a $69 million reverse termination fee. It was over. And so, my friends, the collapse of the JetBlue merger is something that left Spirit Airlines in a uniquely precarious position. They had spent nearly 2 years at this point in merger limbo, during which their strategic options had been constrained and the operational and financial situation that they had already been in that was bad was steadily deteriorating. Throughout the merger process, Spirit had been unable to make significant strategic changes without JetBlue's approval. They had lost key talent who feared post merger redundancies and had deferred important investments and decisions that they needed to make in anticipation that, oh, well, we don't have to worry about this right now because the combination is going to happen and we'll be totally fine. But it didn't happen. And so now, suddenly free to chart their own course again, Spirit faced a transformed industry landscape that didn't really resemble the one that the company had thrived in just a few years earlier. Fuel prices at this time remained relatively elevated due to the ongoing geopolitical tensions, especially with the Russo Ukrainian conflict and the instability in the Middle East. That is something that kept oil prices above historical norms, which was not really comfortable. Along with that, labor costs had surged dramatically across the airline industry after COVID, with pilots leveraging post pandemic pilot shortages into massive contract gains. I think from one of the statistics that I saw on here that Delta pilots would ratify an industry leading contract in March of 2023 with a cumulative pay increase of 34% over 4 years. Very substantial, immediately establishing a new pattern that pilots at every other airline would demand to match. Because, hey, if the pilots at Delta are getting this, then that means that the pilots at American Airlines might just leave. And if the ones over there leave and they're offering even their own benefit deals, then the ones that are at the low cost carriers that don't pay as much, yeah, those pilots are going to definitely jump ship. Spirit's own pilots, which were represented by the Airline Pilots Association, were in active negotiations and ultimately secured a contract in 2023 that brought their compensation substantially closer to the legacy carrier levels, while also adding hundreds of millions of dollars to Spirit's annual cost base. This was something that wasn't really a good experience for Spirit, especially when things were already getting rough. Compounding the labor cost pressure was the catastrophic Pratt and Whitney engine crisis. That is something that emerged in mid 2023 and would disproportionately impact Spirit's operations. Like, this was really bad. At the time that they were already paying way more in labor, Pratt and Whitney's PW1100G geared turbofan engines, which are the things that power the Airbus A320neo family aircraft, they were found to contain a severe malfunction, a severe defect that would involve contaminated metal powder used in the production of high pressure turbine and compressor discs. The contamination would create microscopic flaws that could lead to premature crack development, and that is something that would potentially have catastrophic engine failure in the skies, which you don't want as an airline, of course. And as such, they would require extensive inspections, disassembly, and component replacement on hundreds of engines all over the world. Pratt& Whitney would announce in July of 2023 that approximately 1,200 engines would need to be removed from service for inspection over a multi-year period, with each inspection not taking like a month or so, more like 250 to 300 days to complete. Now, Spirit, which was already heavily in debt, already limited in what they could do, they were uniquely vulnerable to this issue because they operated one of the youngest and most heavily involved A320neo fleets in the entire world, having aggressively transitioned to the more fuel efficient neo variants as part of their cost optimization strategy efforts in earlier years. At various points during 2023 and 2024, Spirit had between 25 and 45 aircraft that were grounded due to the engine issues. At various points during 2023 and 2024, Spirit had between 25 and 45 aircraft grounded due to extensive engine issues, representing around 15 to 25% of their total fleet capacity. While Pratt& Whitney would provide some compensation through what the industry would call AOG, the aircraft on ground payments, yeah, those reimbursements would typically cover only a fraction of the lost revenue that they needed, and the operational disruption costs would only make this worse. Spirit was forced to maintain expensive lease payments for other aircraft, insurance costs, employee compensation for resources that they couldn't fully utilize. It's not even a damned if you do, damned if you don't situation. It's no, Spirit was just screwed no matter what. They were stuck. And so, on top of all of these things, it didn't even matter as much if they had full operational capacity because the competitive environment that Spirit faced after the merger collapse had also shifted dramatically against the ultra low cost model. The big four legacy carriers, American, Delta, United, Southwest, they had all aggressively rolled out and refined basic economy fare products, things that would compete directly with ultra low cost carriers on price while offering more safety nets for mainline service. Still, at the time, free. Big four legacy carriers, American, Delta, United, and Southwest, they had all aggressively rolled out and refined their own basic economy fare products that would compete directly with ultra low cost carriers on price while offering some more of the safety nets that mainline service had. So, like frequent flyer mile accrual, the ability to purchase upgrades for better products, et cetera, et cetera. Though, of course, some of these, like Delta, which is my own annoying thing here, ended up getting rid of some of that, which is absolute crap. Once competition fails, you don't have to do anything. Anyway, I'm not going to rant about that. These basic economy fares would typically exclude seat selection. They allowed only for a personal item rather than a full carry on bag to be brought, and they would prohibit changes or refunds, mimicking many of the restrictions that define Spirit's base product. American consumers, having endured the pandemic and emerged with greater appreciation for travel experiences, would increasingly demonstrate willingness to pay modest premiums for the assurance of full service carriers, the value of frequent flyer benefits, and the avoidance of Spirit's notoriously poor customer service and operational reliability. So, that's a thing. Anyway, throughout 2024, Spirit's financial situation would deteriorate rapidly, like at an alarming pace, as the combination of lower revenue per passenger, higher labor costs, the engine crisis, elevated fuel prices, and crushing debt service obligations would create a cash flow crisis. The airline's revenue per available seat mile remained below their cost per available seat mile throughout the year, meaning that every single flight that Spirit operated actually lost money before accounting for corporate overhead. Spirit attempted a series of strategic pivots that were designed to address their competitive disadvantages, but every single initiative that they launched faced fundamental obstacles. In May of 2024, the airline would announce a major rebranding effort that introduced four new fare bundle options. Go Big, the premium fare including a big front seat, checked bag, carry on, seat selection, Wi Fi, snack, and a drink. The Go Comfy, which was a middle tier fare with empty middle seat guarantee. Go Savvy, a fare bundle with checked or carry on bag included. And just Go, which was the traditional bare bones product. The new structure was designed to capture some of the premium revenue that legacy carriers were generating while also preserving Spirit's low fare positioning at the bottom of the market. The bundled fare initiative, though, produced disappointing results because Spirit's existing customer base was overwhelmingly price sensitive and they were unwilling to pay premium prices, while higher spending travelers who might have at one point considered upgrading, they still viewed Spirit's product as fundamentally inferior to legacy carrier alternatives. Like, why would I pay $200 for a flight on Spirit for the nice version of it when I could pay $250 for a decent service on a legacy carrier that is just as good or better and I actually trust more? The airline also would eliminate change fees for most fare classes in mid 2024, attempting to try to soften their anti customer reputation. But the move would further pressure revenue without actually generating the customer loyalty improvements that Spirit had hoped for. Basically, they already had a reputation, and when they tried to change that, it ended up hurting them because they made even less money off of it. Operationally, Spirit would cut approximately 20% of their planned capacity for the second half of 2024, parking aircraft in storage facilities in the Arizona and California deserts, while deferring scheduled aircraft deliveries from Airbus and also conducting multiple rounds of layoffs that would affect over 4,000 people. The airline would also, at the same time, abandon numerous routes that had been operationally marginal, like routes that made maybe a little bit of money, but not enough to justify the cost. They would withdraw from cities including Aguadilla, Puerto Rico, several smaller domestic markets, and various different seasonal Caribbean destinations that simply were not worth it anymore. And yet, that still didn't really change anything. Spirit's debt situation became increasingly dire over the course of 2024 as the airline faced approaching maturities on substantial debt obligations without having any cash or credit access to be able to refinance them on more reasonable terms. In fact, the most critical near term obligation was $1.1 billion dollars of secured notes that were coming due in September of 2025, backed by Spirit's loyalty program and brand assets, plus around $500 million dollars of unsecured convertible notes that were maturing in May of 2026. They had all this debt that was coming due and no way to actually pay it. So Spirit would hire an investment banker from Perella Weinberg Partners and legal counsel from Davis Polk and Wardwell to go and evaluate strategic alternatives throughout the summer and fall of 2024, including potential refinancing of transactions, equity raises, asset sales, renewed merger discussions with Frontier Airlines, anything and everything that they could do. Frontier would actually return to the table in October of 2024 with another acquisition proposal, this time, though, structured in a way less favorable deal for Spirit shareholders that they had before, given the airline's deteriorated financial position. There was no reason for them to actually offer more money. Spirit's board would ultimately reject Frontier's renewed offer, with directors believing that the proposed terms would inadequately compensate shareholders for Spirit's remaining strategic value and that the airline could achieve better outcomes through restructuring. So that's exactly what happened. On November 18th, 2024, Spirit Airlines would file for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the Southern District of New York, making it the first major U.S. airline to file for bankruptcy since the pandemic era restructurings of 2020 to 2021. Filing was structured as a prearranged restructuring that was supported by Spirit's secured note holders, who had negotiated terms to convert around $795 million dollars of debt into equity in the reorganized company, while providing $300 million dollars in debtor in possession financing to fund operations during the bankruptcy process. The plan called for Spirit to continue operating normally throughout the restructuring, with no immediate impact on flights, reservations, employees, or loyalty program benefits. CEO Ted Christie would issue statements emphasizing that the bankruptcy was a financial restructuring rather than an operational crisis, and that Spirit was going to come out of this stronger, more sustainable as an airline with a substantially reduced debt burden that meant that they could thrive. The airline's existing equity was wiped out in the restructuring, with shareholders receiving nothing for their shares. A very painful outcome for retail investors who had ridden the stock down from their post merger announcement peaks of over $30 per share. Now that was crashing and burning. As a result, Spirit would emerge from their first bankruptcy on March 12th, 2025, with new ownership concentrated among the former secured note holders, primarily a group of distressed debt investors that were including Centerbridge Partners, Pacific Investment Management Company, PIMCO, and several hedge funds that would specialize in airline restructurings. The organized company would have approximately $840 million in liquidity, having raised $350 million in new equity from the noteholder group as part of the restructuring. Total debt was reduced from around $3.3 billion pre bankruptcy to around $1.5 billion post emergence. That is huge, and it would dramatically reduce interest expenses and improve the airline's financial flexibility. Sounds awesome. Okay, what went wrong? Well, the problem is that even with less debt and less overhead costs, the operational and competitive challenges that had pushed Spirit into bankruptcy in the first place still remain largely unchanged. The ultra low cost business model was still being structurally challenged. Legacy carriers were still continuing their basic economy assault on Spirit's customer base. Labor costs were still elevated, and the Pratt and Whitney engine issue that we talked about before, that was still ongoing, which meant that the fleet utilization was still low. The new ownership group would bring around fresh perspectives to try and fix things up, but there were no magic solutions, and the airline's underlying revenue generation simply wasn't sufficient to actually cover their own operating costs, even with the reduced debt service. Basically, throughout the spring and summer of 2025, Spirit would attempt increasingly desperate measures to try and stem their continued cash burn. But every single initiative that they launched ran into the same fundamental constraint. The airline couldn't simultaneously be cheap enough to attract their traditional price sensitive customers while also generating enough revenue to cover the dramatically higher cost structure of post pandemic aviation. As a result, the new management team, led by aviation industry veterans installed by the noteholder owners, would have to implement aggressive capacity discipline, removing additional routes and aircraft from the operation, maintaining only the most profitable routes. The airline attempted to sell or sublease unused aircraft to other carriers, but the global market for the more narrow body aircraft was low due to Boeing's quality crisis having reduced 737 deliveries, and the Pratt and Whitney engine issue was still affecting the A320neo demand. And so Spirit would explore partnerships with other airlines to come to some kind of agreement, maybe joint marketing programs, code share agreements, literally anything that they could do, but it didn't work. Legacy carriers had very little interest in being associated with Spirit's poor reliability record and budget brand. Discussions with Frontier would resume for a third time in mid 2025, but again, they would collapse when parties could not agree on terms, with Frontier increasingly skeptical that Spirit had really any viable value remaining as the airline continued to just crash. So, by late summer of 2025, Spirit's financial position had deteriorated to the point that they had to go through a second bankruptcy filing. The airline would file for Chapter 11 protection for the second time on September 8th, 2025, less than 6 months after emerging from their first restructuring, which is a remarkably fast return to bankruptcy that essentially admitted that the first reorganization had just failed to address any of Spirit's fundamental problems. The second filing was way more dire than the first, though, with Spirit unable to secure any debtor in possession DIP financing on terms that would actually support indefinite continued operation. The court would approve a smaller DIP facility that was intended to primarily fund an orderly wind down rather than another restructuring attempt. And this would signal to employees, to customers, and to the broader industry that Spirit's days as an operating airline were basically numbered. Throughout the fall and winter of 2025 to 2026, Spirit would progressively reduce operations. They would cut their routes. They would return leased aircraft. They would lay off thousands of additional employees, and they would shut down stations at airports across their entire network. From this point, my friends, the only thing that was expected was that it was going to be a slow crawl for Spirit towards its death. It is into the steady decay that the Iran war breaks out, and fuel prices as a result skyrocket, as I'm sure that those of you watching right now are already aware of. This would effectively seal the casket of Spirit that was already laying inside ready to die. Spirit's second bankruptcy restructuring plan had been built around fuel cost assumptions being around $2.24 per gallon or so. But actual prices would surge to $4.60 per gallon as spring rolled around and the geopolitical crisis would unfold. And this would pretty much destroy any financial projections that supported the airline's reorganization plan. By late April of 2026, Spirit's own bankruptcy attorneys were informing the court that the airline's remaining cash reserves would not be able to sustain continued operations much longer, setting the stage for the desperate final weeks for shutdown. During this period, Spirit would aggressively seek a federal bailout from the Trump administration, which had taken office in January of 2025, and which Spirit's leadership hoped, in comparison to the Biden administration that had blocked the JetBlue merger, that Trump would be more lenient. Maybe he'd be more sympathetic. But no, the Trump administration ultimately declined to provide the bailout that Spirit sought, with Transportation Secretary Sean Duffy publicly ruling out federal assistance for the ultra low cost carrier, including not just Spirit, actually, but also even for Frontier or Avelo or others, signaling that there was a broader policy position that the federal government was not going to prop up failing budget airlines. So that was it then. The final Spirit Airlines flight was operated in early 2026, with the airline officially ceasing operation and beginning liquidation proceedings that would distribute its remaining assets to creditors according to bankruptcy priority rules. After 60 years of operation, from Michigan Trucking Company to aviation disruptor to now more of a cautionary tale, Spirit Airlines was gone. Now, my friends, it's at this point in the story, as we're nearing the end here, that we get into the more recent and also weird developments of this entire story. At the time that I'm making this video, it is mid May of 2026. That's also probably when this video is getting released here in the first place. When we're talking about the aftermath of what happened with Spirit, the collapse would trigger an immediate and very ugly blame game across the aviation industry, across the political establishment, varying different commentators and political parties and other parties, all seeking to assign responsibility for what had become one of the most consequential airline failures in the entire modern history of America. Critics of the Biden administration's antitrust enforcement would point to the blocked JetBlue merger as the primary cause of Spirit's demise, arguing that the Justice Department's intervention had eliminated the most viable path to preserving Spirit's operations and ultimately producing worse outcomes for the price sensitive consumers that the lawsuit was supposed to protect in the first place. The Wall Street Journal editorial board and various conservative commentators would argue that Spirit had become the latest victim of the Biden administration antitrust policy, contending that allowing the JetBlue acquisition would have at least preserved capacity, jobs, and competitive pricing pressure that were now permanently lost with Spirit's liquidation. Defenders of the antitrust action, though, would counter that Spirit's underlying business model was already fundamentally unsustainable, regardless of merger outcomes, with the airline having lost around $2.2 billion over the 5 years preceding its first bankruptcy filing and showing no real realistic path to profitability under any ownership structure. Even Spirit's own founders and JetBlue's founder would reportedly acknowledge that the airline was on a troubled trajectory way before the DOJ intervened, and that a JetBlue acquisition might have simply transferred Spirit's losses to JetBlue's balance sheet without ever solving the underlying problems. And really, when I am talking about this, there were some other severe underlying problems. Just as a side note here, an especially controversial aspect of the post-collapse blame game involved the revelations about executive compensation decisions that were made in the weeks immediately before Spirit's first bankruptcy filing. And this, oh dear Lord, my friends, this is so incredibly sleazy. It generated massive public outrage and congressional scrutiny. Investigative reporting would go and reveal that Spirit CEO Ted Christie had received a $3.8 million bonus payment just 1 week before the November 2024 bankruptcy filing, with similar substantial bonuses being paid to other senior executives that had been responsible for the strategic decisions that made the airline collapse in the first place. Critics argued that these last minute payments would represent an egregious example of executives going and trying to extract as much value from the failing company as they could immediately before equity holders and rank and file employees would suffer more devastating losses. and that the bonus timing suggested that executives already had inside knowledge of the impending bankruptcy and structured their compensation to capture payments that bankruptcy proceedings might otherwise have tried to claw back. The bonus controversy would also reignite debate about Spirit's board decision to go and reject the original Frontier merger in favor of JetBlue's higher offer, with some analysts going and arguing that the executives and directors had pursued the JetBlue deal specifically because it offered larger personal payouts despite carrying substantially higher antitrust risk, ultimately destroying the company in pursuit of short term shareholder gains and executive compensation instead of the overall health of the company, the cost of which has been massive. And right now, this is just the beginning. Like at the time that I'm making this, we really do not know how bad it's going to get, but the effects are just starting to be seen in multiple areas. First up is the impact on budget travel in general. Industry analysts have estimated that Spirit's elimination has removed anywhere between 2 to 8% of domestic seat capacity, depending upon your source from the US market. And early data from competing airlines goes and suggests that fares have risen by 10 to 20% on routes that Spirit previously served, with the most dramatic increases occurring on leisure heavy routes between northern cities and Florida or Caribbean destinations where Spirit had already been a dominant presence. The Justice Department's prediction during the JetBlue antitrust trial that eliminating Spirit would harm price sensitive consumers, that, technically speaking, has been validated in a more dramatic fashion. Though, of course, critics are going to note that the elimination occurred not because of the merger, but because it's through liquidation, which has produced way more severe consumer harm than a blocked merger would have caused. Frontier Airlines has now emerged as the primary surviving ultra low cost carrier in the United States. But even that airline faces serious questions about whether or not it's going to be able to maintain profitability as labor costs continue rising and as legacy carriers will continue to refine their own basic economy products. Along with that, in another aspect, the human cost of Spirit's collapse has been very substantial. I mean, over the course of this episode, we've largely talked in bigger terms about the overall company health, but their loss has now affected tens of thousands of employees whose careers were upended by the airline's failure. I mean, Spirit Airlines had approximately 17 odd thousand employees or so when it ceased operations in early May of 2026. And so this workforce would include around 14,000 direct employees and thousands more contractors. And while progressive layoffs throughout 2024 and 2025 had reduced headcount before final liquidation, the rest were effectively left hanging. Among those, the outcome is also not equal either. Pilots who possess actual transferable skills and certifications in higher industry demand areas have generally found new positions rather quickly, with United, Delta, American, and Frontier all aggressively going and recruiting former Spirit pilots to address ongoing capacity needs. Flight attendants have faced more significant job challenges, though, with the post pandemic flight attendant labor market having reached approximate equilibrium before, and now competing airlines are being more selective in their hiring process than they were during the immediate post pandemic recovery period. Mechanics, ground service workers, customer service agents, corporate employees, they arguably face the most difficult transitions of all of them because many of these positions are location specific to Spirit's own facilities, which are not easily transferable to other airlines. Like if you're based out of Fort Lauderdale, it's kind of hard to move your whole family to Atlanta, Georgia if you're trying to work for Delta. It's not an easy thing to do, even if it's possible. Spirit's pension obligations, their vacation balances, their severance payments, all of these have become subject to bankruptcy priority rules, with most affected employees likely receiving only fractional payments on amounts that were owed to them through Chapter 11 distributions that could take literally years to go and complete. Really, people are losing everything. And this drama is something that now at the point that I'm talking about this is extended even to the internet in ways that years ago I personally never would have actually imagined. And so I know at this point we're going to be doing a bit of a side note here. And it sounds weird for me talking about this, doing history and geopolitics, that we're going to be talking about this particular subject. If you know what it is that I am talking about, I'm sorry. What I mean is that I'm going to end this video on two notes surrounding famous internet personalities. One very negative and one positive. The first that we're going to be talking about is the negative one, the highly publicized backlash that James Charles would receive for his own actions during this entire affair. And now, my friends, if you're not familiar with who James Charles is, I don't really blame you. He is not someone that I would necessarily imagine the people who watch my stuff would also be interested in. Again, when I say that, that's my own opinion. I'm just going out there and saying that. But the reality is, this guy is a massive, massive figure. James Charles is a prominent American beauty influencer, a YouTuber, a makeup artist who's known for his makeup tutorials and for being the first male ambassador to CoverGirl in 2016. Now, when I say he's big, I mean he is massive, with over 83 million followers across different social media platforms as of May of 2026. He is a huge influencer. But with that fame has also come a number of very significant controversies throughout his career, including the latest one that now somehow involves Spirit Airlines. This whole thing was completely unnecessary. They may be looking at me right now and going, Stack, how the heck could an influencer worth tens of millions of dollars be involved with an ultra low budget airline? And the answer is that he's technically not. He's involved more with the employees. What I mean by that is that the beauty influencer managed to spark a massive backlash after he posted a curse filled rant about a woman who sent him a GoFundMe link and a message that was asking for support after she said that she was laid off in Spirit's sudden shutdown. In the original video, and I don't know if my editor is going to be able to find it since the original thing was deleted, but if he does, we could probably put it up here. Charles said, and I quote, I just got a DM on here from a girl that said, Good morning, James. I know you'll probably never see this, but if you could take 1 minute to read it, it would really mean a lot to me. I'm really struggling right now because Spirit Airlines just filed for bankruptcy and I have lost my job. Here is a GoFundMe link. Any donations will help. End quote. And so while laughing, he responded, quote, I'm sure they do, sweetheart. I'm sure they do. You know what else would help you? Getting another job. Yeah, try that. He continued, quote, because in the time that it took you to copy and paste the same F-ass message to myself, who you don't follow, by the way, and probably 100 other influencers and celebrities, you could have applied for 100 other jobs. But you didn't because you're a lazy piece of shit. And you're entitled, and you think that influencers and celebrities should fund your life for you. Why would I ever help you? End quote. That's again, that's a direct quote, which, my friends, I normally am not one to judge. You all know that by now. Hopefully, if you've been watching a lot of my different shows and stuff and how I operate on this channel, I try to be as fair as possible when looking at the arguments that people are making, but holy crap, that reaction was just so far out there. Like, realistically speaking, I understand the argument that James is making here. But if anyone out there receives this kind of message, simply ignoring it without putting a person on blast who lost their job for something that is not their fault in the world that we live in today is a significantly better answer. There is absolutely no need to do such a thing. And that action right there does not showcase selfishness, as some people have said, because no, James is not socially or morally obligated to do anything. No, it is instead a shining example of just how incredibly petty, vindictive, and arrogant he is, though. Like, seriously, it just baffles me that some people can be so out of touch with reality that they can look at something like that in their video drafts and without being inebriated in some way think, yeah, that's a reasonable response. I'm sure that people will definitely support me in this. No, just incredibly, incredibly stupid. And of course, the internet being the internet, it wasn't having it. And people started ripping into him, which quickly made him go and delete the video and issue a shirtless apology, which, again, my friends, I know I may be fixated on this, but here is the apology. He said, and I quote, it was rude, it was obnoxious, it was privileged, and most importantly, it was completely effing unnecessary. It was obnoxious, and I shamed her for asking for help in a situation where she was clearly struggling, and this could be her absolute last resort. I feel awful because that wasn't my intention, and I really hurt a lot of people. End quote. I'm super sorry, especially to the woman from Spirit Airlines. End quote. Okay, sure. When we're going and reviewing this, that is definitely an apology. It is. It is absolutely an apology. But I have to pause here on the part where he says that he feels awful because that was not his intention. Because if you go out of your way to call someone asking for help after a crisis, a quote, lazy piece of shit, then absolutely your intention is to shame and hurt them, James. You absolute liar. Anyway, I said that I'm not going to dwell on this. So I'm going to move on to the more positive and interesting story of the internet, that of Hunter Peterson and letsbuyspirit.com, a crowdfunding campaign that represents one of the most fascinating combinations of social media culture and populist sentiment, and even corporate financing in recent American history that I've ever seen. Something that has managed to capture the public's imagination at an exact moment when frustration with airline industries are so high. This has reached basically a fever pitch. For context of this, and I know that I explained part of it at the beginning of this video, Hunter Peterson, a 22-year-old video game voice actor and TikTok content creator, he wasn't a household name before May of 2026, though he did have a modest following on social media through his voice work and entertaining content. Peterson had previously gone viral on TikTok for a video documenting his experience flying Spirit Airlines for 24 hours straight, which is a stunt that did, establish a more comedic association that he had with the budget carrier, and it did give him some credibility with the online aviation enthusiast community that would eventually prove crucial when this whole crowdfunding idea took flight. The prior viral content meant that when Spirit ceased operations on May 2nd, 2026, Peterson was actually uniquely positioned to capture the moment's cultural energy, having already established himself as something of an unofficial spokesperson, if you will, for America's most controversial airline. The campaign he launched would begin on May 2nd, 2026, the very same day that Spirit's operation ceased, when Peterson would post a TikTok video with an accompanying tweet that read, "Let's buy Spirit Airlines slash S, tag the richest person you know." And for anyone who's curious, the slash S notation here indicates that the post was intended sarcastically, like not real, it's a joke. But what was clearly conceived as a joke rapidly transformed into something way more substantial, as that post actually went viral across TikTok, Twitter, Instagram, and aviation enthusiast communities, with thousands of users responding enthusiastically to the absurd premise that, a bunch of ordinary people, millions of ordinary people could just come together and buy a defunct airline. But they did. But they did come together, and that's the thing. So, recognizing the unexpected traction that his joke had generated, Peterson would go and move quickly to capitalize on the momentum, going and launching the website letsbuyspiritair.com within days of his original post, and beginning to position the initiative as not a joke, but a serious crowdfunding effort. The website would allow users to register non binding pledges of financial support, indicating amounts that they would contribute towards an actual Spirit acquisition if the campaign progressed to a formal capital raising stage. And oh boy, the pledge numbers grew at a pace that astonished even the campaign's organizers, with the website going and crashing repeatedly under traffic loads in its first days of operation. By May 4th, 2026, just 2 days after Peterson's initial post, the campaign had collected over $88 million in pledges from more than 124,000 individual participants. By May 7th, the total had climbed to $214 million from 247,000 pledgers. And by May 10th through the 11th, the figures had reached at least $377 million from more than 371,000 individuals, according to Aerotimes reporting. But other outlets would cite slightly different but also impressive numbers that could range from 335 to $370 million. It was all over the place here. The campaign would brand itself with various different names, including Let's Buy Spirit and Spirit 2.0, and they would try and articulate a vision of transforming this failed airline into what supporters would call the people's carrier. It would be a publicly supported, community backed airline that would be owned by its passengers rather than by traditional corporate investors or private equity firms. This more populist framing is something that would draw comparisons to the Green Bay Packers, which, for anyone who's not familiar, or if you're outside of the United States and you maybe aren't familiar with NFL teams, the Green Bay Packers are an NFL franchise that famously is owned by its fans through a very unique nonprofit ownership structure, with Peterson and his supporters suggesting that a similar model could work for an aviation company. At this point, Peterson's vision for the campaign would expand rapidly beyond simple fundraising, as he sought to build out the operational infrastructure that an actual airline acquisition would require. In a TikTok video that was posted on May 3rd, he would explicitly call for various professionals to join the effort, specifically requesting connections with developers to upgrade the pledge website so that they could actually handle the massive traffic that it was receiving. Public relations professionals to manage news outreach and shape the campaign's media narrative, lawyers who had experience with the aviation industry and transactions, and former airline executives who could perhaps provide the operational expertise that Peterson and his fellow content creators very much obviously lacked because he was a 22-year-old entertainer on the internet. I say that as a 31-year-old educational entertainer on the internet. This recruitment effort is something that wasn't just a joke. It acknowledged the fundamental gap between viral social media momentum and the practical capabilities that were actually required to operate an airline. Which is interesting because the approach does reflect a more modern theory of organizational development, treating the airline acquisition as something that could be assembled through online collaboration in the same way that you've had recently open source software projects or decentralized autonomous organizations, crypto communities, all different kinds of things that have built more complex technical systems through their own distributed contribution, where different people are working on different things at the same time to create one big picture. But still, despite the very impressive headline numbers and the undeniable cultural resonance that this has, the practical mechanics of converting the Let's Buy Spirit campaign into an actual airline acquisition, it's way harder than you would think. It faces an extraordinary array of obstacles that aviation industry experts and security law specialists have pretty much universally characterized as practically impossible. So I don't want people in the end here to think, oh, this is definitely going to work. I don't want to give anyone an overly inflated false sense of hope. And I'm going to explain that. The most fundamental issue involves the legal status of the pledges themselves. These, if you remember what I said here before, are explicitly non binding commitments rather than actual financial contributions that are held in escrow or otherwise legally enforceable things. Participants who have pledged amounts that could range from $10 to tens of thousands of dollars, they have made no actual payments. They face no legal obligation to follow through if the campaign progresses towards an actual transaction. Industry experience with similar pledge based fundraising suggests that the conversion rate from the non binding pledges to making an actual monetary pledge and a payment is typically quite low, oftentimes being like 10% to 25%, even for organizations that are way more well organized with clear deliverables and everything already lined up. Meaning that the $377 million dollars in headline pledges might more realistically be 37 million to $100 million dollars in actual funds if the campaign somehow even manages to reach a payment collection stage. Even this reduced figure, though, that's still very impressive. It is a remarkable crowdfunding achievement, but it would fall dramatically short of any real purchasing or operating of an airline. Along with that, the securities law obstacles facing the campaign are especially daunting, and they've been emphasized by legal experts who've evaluated the initiative and found that it's just not really able to work as it is. Standard equity crowdfunding under Security and Exchange Commission regulation crowdfunding, Reg CF. This is a law that caps total fundraising at approximately $5 million per 12-month period. That is a limit that if this actually went through and they got 300 something million dollars, that would exceed that limitation by multiple orders of magnitude. In any realistic Spirit acquisition scenario, it's not able to happen. Columbia University law professor John Coffey Jr. would specifically note to NBC that traditional crowdfunding rules impose fundraising caps way below what is needed to buy an airline, meaning that any serious effort to actually raise the required capital would need to navigate substantially more complex regulatory structures. Alternative approaches that could theoretically accommodate larger fundraising do include Regulation A plus offerings, which allow raises up to $75 million dollars annually, but that also requires more extensive disclosures of documents and SEC qualification and more. Private placements under Regulation D could also work, which avoid SEC registration, but they generally require investors to be accredited, meaning they must meet income or net worth thresholds that exclude most retail participants who have pledged to the campaign. Or they could do a full public registration with the SEC, similar to an IPO, the initial public offering that companies do. They could do any number of these things, but each of these alternatives carries massive substantial costs, which would take many months to complete and require expensive legal, accounting, and underwriting support that the campaign, quite frankly, simply doesn't have. Even assuming the legal and securities law, despite all the issues, could somehow be overcome, the financial scale required for an actual Spirit acquisition substantially exceeds the campaign's current pledge totals. Industry estimates suggest that Spirit Airlines has a market capitalization of around $2 billion as of early 2026, before its final collapse. Though this figure also substantially overstates what would be required to purchase the company's remaining assets from bankruptcy liquidation, since equity holders typically don't receive anything in Chapter 11 proceeds. The most relevant figure is the cost of acquiring Spirit's operational assets, the aircraft leases or the purchases, the airport gates, the slots they have, the brand and intellectual property rights, the operating certificates, literally any kind of asset that Spirit still maintains, plus the working capital that would actually be required to restart operations. Because even if you spend all your money to get the airline, if you have no money to actually keep it operating, it doesn't do anything. Industry analysts estimate that this could cost an additional $1 billion and possibly several $1 billion, depending upon the scope of operations that are attempted. The complete restart of a major airline from a cold start has rarely been attempted successfully in modern aviation history, with most airline launches building gradually from single aircraft operations rather than attempting to immediately replicate a former major carrier's network and fleet. On top of all of this, assuming literally everything from the very get go was bought and paid for, the regulatory approval requirements for actually operating a resurrected Spirit Airlines just creates another layer of challenges. Any new airline must obtain certification from the Federal Aviation Administration as an air carrier under Part 121 of the Federal Aviation Regulations, a process that typically takes 12 to 24 months and requires demonstrating operational capability, maintaining procedures, training programs, and financial stability that an internet crowdfunding campaign would definitely struggle to establish. The Department of Transportation must also separately grant economic authority to operate as a commercial airline, which includes fitness reviews of the carrier's financial resources, managerial competence, and citizenship qualifications. Federal law, for anyone who's curious, requires that U.S. airlines be owned by U.S. citizens, with at least 75% of the voting equity in it being held by American citizens and the airline being under the actual control of American citizens, which creates a more complex compliance issue for a crowdfunding ownership structure where there are hundreds of thousands of small participants. Regulatory experts who have evaluated the campaign have generally concluded that the practical obstacles to actually obtaining all the different necessary government approvals would likely consume years of effort and millions of dollars in legal and consulting fees before any aircraft could ever carry a single passenger. And so, because of that, the skeptical reception from aviation industry professionals has, as you could probably expect, been pretty much uniform, with experienced analysts and executives expressing polite dismissal of the campaign's prospects despite its viral success. Robert W. Mann Jr., a former airline executive and the current president of R.W. Mann and Company, an independent airline consultancy, would tell USA Today that Spirit would have been rescued already if it had a viable business prospect for the future, implying that the underlying economic reality that drove the airline into liquidation into the first place is not something that is going to be altered by a crowd-funded effort or group ownership. Charles Elson, a corporate governance expert, similarly told NBC that the campaign's prospects of actually completing an acquisition were extraordinarily remote, comparing the likelihood of going to Mars and noting that the complexity of the deal was massive with lenders, aircraft lessors, union contracts, and many other stakeholders being involved in any actual airline transaction. The Reddit aviation community, including former Spirit employees and industry insiders, would also be quite skeptical, with one popular comment noting that Peterson has, quote, zero qualifications to run an airline and wouldn't even qualify for a very junior leadership role, End quote. Yes, they would also observe that the publicity benefit to Peterson personally is essentially unprecedented. It is massive and will probably not go away so quickly, even if the campaign never produces an actual airline, but it's still there. And so, either way, despite these substantial obstacles, the Let's Buy Spirit campaign has actually accomplished something very culturally significant, something that really should not just be dismissed simply because the literal goal of it, of buying an airline, remains practically impossible. The campaign has demonstrated remarkable collective dissatisfaction with the current state of American aviation, channeling consumer frustration about high fares, reduced competition, the perceived failure of regulatory policy into a tangible thing, if also more symbolic protest movement. The hundreds of thousands of pledgers who have signed up represent a substantial population of Americans who feel passionate about budget air travel to publicly commit themselves to its preservation, sending a market signal that there actually does remain substantial latent demand for the ultra low cost service category that Spirit's collapse had basically eliminated. Some observers have suggested that the campaign's true significance lies not in its literal goal of reviving Spirit, but rather in the demonstration that this consumer owned airline model is something that deserves more serious consideration, potentially inspiring legitimate efforts on a smaller scale by more experienced entrepreneurs that want to launch new budget carriers backed by community investment structures that still comply with applicable security and aviation regulation. Looking forward, my friends, the most realistic prospects for the Let's Buy Spirit campaign likely involve some kind of transformation from its current form into either a symbolic advocacy organization, a more conventional investment vehicle that is backed by professional management, or simply it will remain a cultural movement that fades as Peterson and his supporters move on to other initiatives. There is no indication that the campaign currently has any formal role in Spirit's actual liquidation proceedings, or, for that matter, any access to the bankrupt airline's assets, which remain under the jurisdiction of the bankruptcy court and are being distributed to creditors according to the established priority rules. The aircraft, the gates, the slots, the brand assets, all the valuable components of Spirit's former operations, those are being sold to established airlines and aviation companies through normal bankruptcy procedures, with proceeds going and flowing to secured creditors that hold legal priority over any new buyer who might emerge from a crowdfunding campaign. Even if Peterson could somehow go and assemble the necessary capital, get the regulatory approvals, and the operational expertise, the actual assets that are needed to restart Spirit are being dispersed to other parties as the campaign progresses, making the literal goal of reviving Spirit Airlines more and more impossible with every passing week. Because of that, the most likely outcome is that the Let's Buy Spirit campaign will join a small but notable category of viral crowdfunding phenomena that would go and capture the cultural imagination of the public without ever actually producing what was promised. Similar to other more meme driven financial movements of recent years that generated tremendous attention and energy without actually fundamentally changing the underlying realities that they tried to address. Hunter Peterson will likely emerge from the experience with a larger, more enhanced public profile, with expanded career opportunities and content creation, and maybe even the aviation industry. We don't really know, or advocacy for it. Also, he will get the unusual distinction of having organized one of the largest non binding pledge campaigns in internet history. Hundreds of thousands of pledgers will likely remember the moment as simply an exciting expression of populist energy that connected them to others that had a similar frustrating experience about the airline industry. Even if their actual financial commitments are never collected and the airline they pledged to save never returns to the sky, it doesn't really matter. In the end, my friends, the Spirit Airlines collapse is likely going to be studied for decades as a defining case study in modern American aviation, in business strategy, antitrust policy, corporate governance, and more. The airline's trajectory from being a struggling regional carrier to ultra low cost pioneer to an industry darling, and then almost immediately after to bankruptcy and liquidation is something that encapsulates the more dramatic transformations that would reshape American air since deregulation in the 1970s. Spirit's failure is something that represents simultaneously the end of one era and the start of another, with ultra low cost models that dominated industry growth for the last 2 decades, giving way to more new competitive landscapes characterized by greater concentrations among legacy carriers and more sophisticated fare segmentation through basic economy products and reduced choice for more price sensitive travelers that had depended on Spirit and their bargain fares. Whether this new landscape ultimately produces better or worse outcomes for Americans consumers, though, will be determined by factors that remain uncertain. The trajectory of fuel prices, the evolution of labor costs, the effectiveness of competition policy, all these varying different responses of surviving airlines to the opportunities and challenges that Spirit's disappearance would create. We don't know what'll happen because what remains beyond dispute, though, is that Spirit Airlines, for better or worse, it fundamentally did change how Americans would fly during its 6 decades of operation, and that absence is going to be felt across the entire industry for generations to come. Thank you, my friends, for watching. That is the end of today's video. I really do appreciate it. I know this was a long one, but I ask that you like, comment, and subscribe, and also let me know in the comment section below what it is that we would like to do next. I have a series of things that are coming up. After this, I have a whole thing on Russian vodka politics and the destruction it's causing within Russian society. So that is something. I'm also planning on doing a thing on the California homeless crisis because that was requested a while ago. And there's a lot of crazy stuff that is happening with the LA mayor race. Sounds weird, I know, to focus on, especially for anyone who might be in Europe that watches me and doesn't know what I'm talking about. There are some spicy things happening in California. We're going to have to go back and address that after the whole rail video that I did. Thank you, my friends, again for watching, and I'll see you all next time. Goodbye, everyone.
But hey, my friends, here at the end of the video, I want to thank MyHeritage again for sponsoring me. If you want to click my link down in the description, use my code HISTORY19 for a great deal on their DNA kit, or go and scan the QR code that you can see up here. I would really appreciate it. Let's see if anyone out there is actually related to me. This also comes with a 30-day free trial to MyHeritage as well as free shipping. You really can't beat this deal.